Early, but welcome back to Markets with May. I accidentally hit the button just a touch early, but hopefully that doesn't cause any kind of grief. Today, we're going to be talking about the private equity companies. And I started researching the private equity companies because liquidity really does bubble through and depend upon certain elements of the financial system to come in and try to help, for lack of a better way to say it. The interesting thing about the banking crisis that we're seeing is the bank runs are forcing liquidations, of which then the Fed takes it all in. But what's fascinating is if you go through where liquidity flows through the system, what's beautiful about the private equity companies is that they really do have, they start to be the first spot where you get a sense for permanent capital. And their permanent capital comes in from a very particular place. So what I'm going to do in this episode is I'm going to talk a little bit about the macro trend that's helping private equity in general and has been for some time. And then I'm going to go through just some basics about the three biggest players, Blackstone, Apollo, and KKR. I will do just the components of the financials that I find relevant currently. In fairness, anybody that's researching the financials of a private equity company, you're pretty much a rock star because they are the hardest to understand in some ways. And in a lot of other ways, maybe they're not so hard. But we'll kind of go through just the briefest. This is not meant to be a pitch. Okay. This is not a pitch video. This is more of an industry overview and how I'm currently thinking about the private equity firms because they absolutely do have a role to play in all of this. Okay. Past performance disclosures, past performance not indicative of future returns. I will admit that I do have a small position specifically in Blackstone, who of the three, the arrows are pointing a particular way for them, more so than the others. But in fairness, I'm at the very beginning of what I would need to do to feel passionately about any of these three. But of the three, Blackstone. Okay, let's get into it really quickly. Okay. So, what is private equity? I noticed when I was talking to different people this week that people have this vision of what private equity is. And I even noticed that some of the slides that I Googled, because I was like, what are people seeing that they like? Why is their vision of private equity so different than what I absolutely know private equity to be? You know what I mean? And this is part of the reason why this slide, which I pulled straight off the internet, and there's like hundreds that look like this, is actually missing another big section of private equity that is pretty relevant and is pretty important to, if anyone were ever to look at these companies for investment in the equity portion, not in the actual funds that the private equity guys run, you'd need to understand. But the portion that's got everybody up in arms and upset with the private equity firms and has been, for the entirety of last year and this year has really gotten, you can see the charts of any of the three that we're looking at just been clobbered, is the venture capital piece. But the venture capital piece and these others, buyout, special situations, and growth, these are all kind of a portion of private equity, I would say. Clearly, venture has had a lot of its funding come straight out, no matter what stage of capital you're in. Clearly, that was a component to Silicon Valley Bank. But what I want to remind people is a huge component of private equity is actually this. It's the private equity of unlisted companies around the world. And in that regard, we should have a conversation. It's also private real estate. And I would say a couple of things that you guys can see from my past videos. I just did a video on why I'm also reviewing and dusting off the cobwebs on the residential REITs. But everybody loves to talk about how CMOs are doing poorly, the mortgages are doing poorly, but they fail to differentiate that that private real estate has as many segments as anything else. So while it is the case that office REITs have been weak, it is not the case that other forms of real estate have been weak. If anything, we've been seeing rising rental rates due to high increasing interest rates. So they actually would then own the business itself, not in a REIT format or in any other format. Private debt has also been very interesting because, hey, very straightforward. If the capital markets dry up, but you need that funding to do something expansive that's necessary, you're going to go to the private debt markets. And that is what the private equity guys do. And then private infrastructure is also a big thing. So this would be sometimes municipal funding, what have you, or it could be, as you see, the little satellite dish. There's lots of different ways that this can be structured. Private equity solves this problem. And for whatever reason, so many things that I was looking up in the internet, because they were organizing this way, which all of those four things are technically embedded in this way of dividing out the market. But I think this way is probably a little bit easier to see why throwing out the baby with the bathwater on private equity just because venture's doing poorly might be a little bit lacking in nuance, let's call it. Okay. Now, let's also talk about the other thematics that have been helping this entire sector for some period of time. And it's really kind of a subsector in some ways, I guess, or sub-industry grouping. But if you look at it, let me do this. It's this slide right here. So this is an article from a bit ago. New York raises its cap on pensions, private equity, hedge fund assets, right? So that really begs the question, how much capital and what does it imply? And it's actually kind of extremely important. It's kind of extremely important to appreciate this flow of funds and what it means in the context of almost a decade worth of changes in asset allocation. Now I want to show you, I want to show you this. I actually presented this the other day when I was talking specifically to my pension followers who had questions on how to think about their public pension and whether Silicon Valley Bank was going to cause them a big set of problems. This is actually the yellow, green, and orange is the increase to private equity and hedge funds. A lot of hedge funds are embedded within a private equity fund, depending on the nature of what it is you're investing in. And you can see that allocation has increased significantly since post 2008. Pre-2008, your private equity allocation may have been 5%, less than 5%, but it would be mixed among the green, orange, and yellow. And now that number for a lot of public pensions has gotten to significantly larger, like 35%, as you saw in the article above. And the reason for that is actually many years in the coming. And it really has to do with this. This is just for the statewide pensions. You can see that from 2008, because of 2008, you had this massive collapse in the funding ratios, meaning they were underfunded. And they've been trying to get out of that underfunded state for some time. This estimate comes from equable.org, and it only covers the statewide pensions. It does not cover the bigger pensions or the corporate pensions or the pensions that are overseas. But all of them essentially to get that return profile and not have to take the marks. Because another thing that's often not discussed that happened in 2008 is that if you had to take a mark, then it was really painful. And you'll have to take that mark at the point at which you cannot pay out on your cash. In 2008, not so unlike the banks as of current, they did have an issue paying out as far as that goes. And so now they don't do it that way is what's happening. But you can see the underfunded status that they've been trying to catch up for some time. Now, again, like I said, this is US, et cetera. Some of the big sovereign wealth, et cetera, are a little different, which I'll show you in a second. But you still have a lot of pension funds playing catch up. And as a result, they've moved out of liquid assets into illiquid assets in the case of private equity, or they've allocated it to higher yield, I'm using as a loose term here, okay? Hedge funds. All right. So that is the overall long-term situation that's happened within private equity. Hence, I care a lot about the health of private equity funds and what's going on. Now, I've got a couple more slides to show you before I get into just the basics of Blackstone, Apollo, and KKR and why I actually think it looks a lot better than I would have thought, like significantly better than I would have thought. Okay, a couple things I just want you to know. Here are, just to give you a sense, this is pension funds and sovereign wealth funds by far are the largest pool of assets. And what I mean by that is that, yes, the retail, et cetera, et cetera, et cetera. But if we're talking about who are the whales out there that would really be moving the entire market, it's always going to be these guys are so ridiculously large, but they've largely speaking externalized the running of their money to people like BlackRock, Blackstone. BlackRock really has about 10 trillion at their height. Now they're closer to 8 trillion because of what's just happened in the market correction. But these guys are very large. Now, this is a subset of the total pensions, even though it's listed this way. It comes from globalsovereignwealth.com, globalswf.com. You can see my little slide here, the citation. And I know this is not the correct number, this 31.4 trillion, because OECD pension report 2022 states 60 trillion in pensions. And it is very hard to get the totality of what the pension business is. So I'm not even upset that this very proper organization has misstated it, and probably needs to make just a little asterisk on their statement. So sovereign wealth is going to be about 10.6 trillion. That's going to be harder for you to mess up. Sorry, 11 trillion, and they did actually better than expected last year, despite the market being crazy. Okay, for lack of a better way to describe it. And a huge component of that is because sovereign wealth and a lot of the larger public pension funds are not market marked on a lot of the different types of investments that they do. That's just truth right there. And also, they were in very conservative assets to begin with. Okay, but like I said, about $60 trillion in pension assets, according to the OECD pension report, is what we're talking about. Most of it is U.S. pensions, but the U.S. pensions are not the largest pensions on the earth, believe it or not. Actually, there are significantly larger ones in Scandinavia, et cetera, and in the Middle East. So all of these guys are moving their assets, and have been for some time, out of the public markets into the private markets. And this has been helping assets under management within private equity for some time. Okay. For some time, assets have been moving out of the public markets and moving into the private markets. And I actually think that's ironically a smart move, because the volatility in the public markets has gotten kind of loco. All right, now let's talk about what actually happened last year with investments, because I think this is where people get very confused when they listen to the market commentary on Silicon Valley Bank and then try to extract that into the private equity firms themselves. They kind of have a couple of missing pieces there. Oh, really quickly, corporate pensions actually are overfunded at this point, or well-funded, not overfunded. Okay, so the one thing that I just want to mention, and I've talked about this, and I realized that when I was talking about it finally, that what I was saying just wasn't something that was straightforward to a lot of people, and that's this. Global, just because private equity volume, if you look at this chart, the volume of private equity deals that were done last year was down by 20%. And the total value of the deals that were done were down 44%. And so a lot of people perceive that as private equity is doing very poorly. Okay. And in fairness, the portion of private equity that constitutes this decrease is the venture piece by a lot. Okay. By a lot. However, and this is really important, is a different part of private equity actually did better than okay, and that's the take privates. The take privates had 91 public to private transactions with an aggregate of 245 billion, which is a record high. And so those of you that follow my Twitter post, I posted some things related to that, and I could tell immediately that this was just some article and some trend that I've been watching that maybe isn't as popular in understanding where it sits within the landscape of all finance. And this is kind of the way to think about it. And what it then implies for markets in general in the future is interesting in itself. We may or may not want to get into that as a function of today's conversation. The other thing that you kind of have to know is that private equity, and especially these three private equity firms, they don't have to deploy capital if they don't see things that are interesting. Somebody said to me in an argument, and then I was like, oh, I'm just going to stop discussing this at this point, because I can tell this person doesn't actually know enough about the business. And it's fine that you don't know enough about the business, is what it is. But private equity does not actually have to deploy the capital that it's been allocated, because the way that the fee structures can be done are quite special. Like sometimes you pay fees a certain way, sometimes you pay fees a different way. There is also this concept of a sidecar, which means I have absolutely allocated capital for you to access in a sidecar once you finally find the investment that's interesting. So as a result of that, you can have you could have a lot of what they call dry powder. You can have a lot of just cash that's uninvested at a private equity firm. So that's why I started researching the private equity firms this last couple of weeks, just to review like what's going on with their financials. How did they report the fourth quarter? What they say was going to be their strategy? Because look, they reported probably end of February. They were, they've been all along not allocating to private equity. I'm sorry, to venture capital. So they definitely had a particular opinion. Now, let's go into these three so briefly. Oh, sorry about that. Let's go into these three so briefly. And again, the way that you would have to do the financial work on these is far more than what I'm going to show you. So I want to show you this first and foremost. And it's really interesting because you cannot just listen to someone who's taking the numbers from a data feed, because how the numbers of specifically all the financials, but in particular the private equity firms, feed into a data feed are like, that's very dangerous. So you cannot be like, oh, let me just do relative value based on price to earnings, blah, blah, blah. No, you're actually going to have to go in there. And then even after you go in there, this is just going to be like maybe the first layer. You're going to have to go and actually take a look at the investments that they're in, because a private equity firm really is only as good as its investments. And most of them hire amazing people. So that part you don't have to be quite as concerned about. But when we look at private equity, particularly Blackstone, which got very clobbered, but Apollo and KKR report their numbers ever so slightly differently. Blackstone, I love how Steven Schwartzman reported this because it's so clear to see what's going on in private equity. They make money off of fee revenue. Okay. Fee revenue is I gave you money, given that you make me money, I will charge a fee. And then there's just a fee that you take for just having that money. And so there's management fees, advisory fees, and performance fees. These are all different types of fees that they can take. There may be others. If you're a private equity person watching this, go ahead and stick it in the comments because you do know best, probably. That's fine. But what's beautiful about this is you can kind of see from the numbers that fee-based revenue did fantastic. Revenue was up a lot. And I'll show you Apollo. It's the same thing for them as well last year, despite what happened in the markets. Let me tell you something that may or may not be the same for the hedge funds. Hey, Juicy, got you crazy? You guys are so fun in the comments. Make sure that while you're watching, have the comments up, because I love everyone that comes and supports this channel. So I want their comments to be seen as well. Okay, but the investment income losses, depending on how the data feed fed it through, sometimes show in the most bizarre way. I love that Blackstone did the effort and work to show you what that looks like for them in this slide. I did not see the same thing in Apollo and KKR, but it's possible that it exists in one of their many documents. Like I said, I'm still reviewing all the documents I need to feel comfortable. But so the data feed in some cases might read revenue down 93%. And what they're reading is performance allocations, realized and unrealized, and principal investments, realized and unrealized. Okay, what's that mean? All right, performance allocations are the piece. So when you invest in something, let's use a building, for example, to make it easier. Let's say they co-invested in a building with a pension fund. Let's call it that, right? Or whoever invested in the fund. There's a piece of that that's the principal investment, and that will have a realized gain and an unrealized gain. Usually the realized gain at sale, but could be something else. I'm not going to pretend like it could be that they did a second round of funding, and so there's a realized gain. There's a couple of different ways, not an accounting expert, but that's the principal component of it. And then you have the performance allocation, and that might be for something where there was, if the building does this, then you get the performance, you get a little bit of a kicker for having done such a good job investing. Okay. That's awesome. And so the performance allocation is also really relevant. And in 2021, the earnings you can kind of see you had huge kickers in all of the allocation, the realized losses, and your unrealized read as a positive. So that, as we know now from Silicon Valley Bank, with all this attention that's looking at unrealized losses, is now showing a little bit of an L. But as I've said over and over again, for all of those people that are so focused on unrealized losses, as long as you don't have a liability with a very short time component associated with it, the unrealized losses is just a paper loss. It would be the same as if your accountant forced you to take a loss on your apartment every single time, or your house every single time the market swung around on a given day. It wouldn't make sense for the asset class or the investment type. And that's therefore how you read it in a private equity financial statement. Okay. You would not think that that silly rando mark to market is actually changing the cash flow, the cash money that's coming in. So, like, a lot of the cash money that's coming into these private equity guys is as stable as can be. It's a toll booth or something like that, that has a certain amount of cars that drive in and out of it. Yeah, maybe there's slightly less cars, but more or less taking an unrealized mark on something that's cash flowing like crazy is cuckoo for Cocoa Puffs, for lack of a better way to describe it. And so you really want to look at it that way. All right. So I just wanted to show you that for anyone that does want to do further work, that you're going to have to do that work and then really think about what the assets are. Let me show you a couple other things with Blackstone. Blackstone, I really like. It is the largest of the three public private equity firms that I bothered to look at. There may be some smaller private equity firms, no shade as far as that goes. But when you look at it, they divide out total AUM is 974, almost $1 trillion, let's call it. And they continue to raise more assets because, it's there's, like I said, there's this larger trend that's coming through the marketplace. And, then it comes down to, are they taking any losses on the other assets that we want to talk about? And I would say that given the nature of Blackstone, the losses that they take may or may not be, we don't know. Okay. So just a little bit touch early, but my suspicion from what I heard on the call and from what I know of this firm and from looking through what I've looked through thus far, okay, is that they are probably going to be more than okay. But not only are they more than okay, so perpetual capital, a lot of that is just capital that isn't going anywhere. Some of it may be because the partners themselves, which are 36% of the total capital, from what I understand, is in that bucket. And unless they're leaving, which partners don't usually leave like that at a private equity firm, that's not going anywhere. So there's that. But AUM was up 10%. So they raised capital into last year. This was legit a place that the big pension funds, sovereign wealth companies, they moved their capital from other marketplaces. Debt, they moved it from public equity into private equity. That's what that ultimately means. And we see the same trend at Apollo and at KKR reporting their earnings. So what then did they deploy as relates to that capital? Blackstone provides this slide. I'll show it to you on Apollo as well. KKR, I have to go through. I couldn't find something like this. But here's Blackstone. And they say they have 186 billion in dry powder, which if you just do the math is about 20% dry powder. For context, that's actually a lot of dry powder, okay? And that matters to me a lot because if things really go sideways, they got a lot of money to just cherry pick the things that are the most interesting, right? So that's very cool. It's not that they didn't deploy capital, and Steven Schwarzman did talk about this on the earnings call as relates to the real estate assets that everybody is all crazy about. Hold on, I got this massive shadow on my face, you guys. Vanity first sometimes. I don't know if I'm not going to be able to get it off because of the lighting. It is what it is. All right, sorry guys. But because Steven went through this on the call. I don't know why I call him Steven. I don't know him personally. I wish I did though. He's such an amazing guy. I think I've met him one time at a public speaking engagement. Very well spoken. Anyways, he said on the call that the real estate assets that they have are primarily non-office. So that is that is what it is. So just realize that. And that they're seeing exceptional fundamentals and being able to raise rent for the rental assets that they do have, the buildings that they do own, which would be residential and warehousing and medical. Right? And that is consistent with what those REITs have reported. That's why I did the piece, the industry overview on residential real estate last week. So hopefully you guys can take a look at that. But so far, he's feeling really great about the returns that he's seeing. And in fact, that does synchronize through on the fees that they're then being able to get, the performance fee component of what they're actually able to get. both at Blackstone, Apollo, et cetera. So realize that despite the hype, there's sometimes a misunderstanding of what that means for private equity. And let me just go through the other relevant stuff here that I just want. Here's Apollo, and they have about 9% undeployed. So that's why I'm a little bit more positive. AUM is about 548 billion. I don't know why I had stuttered when saying that. So about half a trillion, making them about half the size of Blackstone. And then when we look at KKR, we see they didn't have the same. I guess the guy who made their deck wasn't the same as the other two. And you can kind of see when you extract these numbers, though, you do end up, I think, probably they're about the same as my guess without being able to see it through all the numbers as of yet. So they probably have 9 to 10% dry powder, but all that dry powder at Blackstone makes me very interested in it. Additionally, the other thing that you can kind of take note of is that Apollo was the original buyer of Credit Suisse's distressed assets. We saw that in the fourth quarter. You guys can take a look at my fourth quarter recap of Credit Suisse that's back in February. I will link it in the bio at some later time, or not in the bio, in the show notes at a later time. They clearly backed out of that, is what I think happened, along with some other things once Silicon Valley Bank happened. And they have been putting out like lowball bids on some of the stuff that's been happening. That's in the news as well. But it makes it such an intriguing time to at least be like a little bit smarter about the public version of these companies that are investable by equity shareholders. Let me see. I feel like there's one other thing that I just wanted to show briefly. No, I didn't really. Let's see. Now, I think that's about it. Yeah. So I will kind of stop it there. Yeah, let me just show this really quick. This is KKR's fee revenue, just so you can see that the fee revenue improvements are consistent across the different private equity firms. Their fee-based revenue was up 11.3%, which was the highest I think they were saying it's the highest it's ever been, because assets under management are also the highest it's ever been. So they had a great year as well on fees. Obviously, there's other stuff that clanks through the financials, for lack of a better way of describing it, that also have to be taken into consideration. And with that, I don't see questions, but I do want to give some shout outs. Carlos, KG. All right, look, I know there's a lot of different feelings, and that is something that you should absolutely research when you're looking at private equity firms, okay? You want to feel that they're aligned with the way that you think about things. And that is a fair point. The other thing that I would say is that there are some lawsuits out there always, because when you've got, in particular, there's one even for Blackstone, as I am so positive about them, in the state of California, because they bought a bunch of residential dormitories, which is legit a form of residential real estate. And the students are so upset because they're like, all they're going to do is raise rent on my dorm fees, and it's going to be more expensive. So all that stuff is a part of due diligence if you choose to go further. I would also mention that Blackstone has about a 5% dividend yield. The other two have not had their dividend collapse so aggressively. All of them actually raised their dividend yield because the fee-based revenue is going well. So those are the other things that those are the other things that I would throw out there. But yeah, definitely SH. I'm not always right. I have no problem admitting that. I've been very clear that I'm not certain, but yeah, I want everybody to do their own research and start dusting it off. But hopefully this tutorial will in fact give you kind of some context, if for nothing else, context into what you're hearing in the news and stuff like that. And there were a couple of questions which I'll just answer. When the US dollar will stop being the global reserve account. Okay. Okay. This is a really good question. And I know that reserve currency is very big right now in the marketplace. And here's what I have to say. I'm not of the opinion that the US dollar will become not a global reserve currency, because that's not the nature of how, and I don't want you to take this the wrong way, because you might mean it in one context, I mean a different context. The US has a 60% market share of global reserve currency. That is down from 80% a decade ago. Let me call it that. 2 decades ago, really, because 2 decades ago, in the 2000 period, they stabilized the euro, and the euro started to take market share from the US dollar. Before that, you really had the US as the major and focused reserve currency, and that was what it is. Okay, so in the last 2 decades, you've seen a decline in the reserve currency as the U.S. My goodness. Sorry. I'm getting dings like crazy. In the last 2 decades, you've seen this slow change. Now, do I think that it would ever go to zero at this point in history? I think that's really aggressive, really aggressive. But do I think, sorry for all the beeps, guys, but do I think that the reserve currency percentage market shares are going to change? I'm fascinated. Unclear. I do think that right this minute, you can clearly see the Chinese renminbi, which I think people call the yuan for whatever reason. I've always called it the renminbi, but it is what it is. The renminbi has gone from not at all visible as a part of any market share of the US dollar to reclaiming the portion of people that were investing in the Sing dollar because they were synthetically trying to get exposure to the renminbi, to now being 3% of global currency, which is up a full percent from like maybe 3 to 5 years ago, pre-COVID. So the Chinese currency is increasing its market share. If I had to say like what is probably higher probability, the Chinese currency will increase its market share over something. I don't know what that something is, because just as much as everybody is staring at the US dollar, it could be the case that that market share comes out of the euro. And the other two options would be the Japanese yen, which is sitting there with, I think, around 6%. Don't quote me on that. I have other slides on it from earlier presentations, but 6%. And I think the British pound still carries around 5 to 6% market share, something like that. So it absolutely could take market share from those two. And then you might only see a little bit of a shift in the US dollar, or you might see a bigger shift. It just depends how fast and what you think is going to happen to the renminbi. The Chinese yuan, same words, just cognates depending on what people are used to saying. So there's that. Now, gold is also something that people talk about from time to time. History of gold, because sometimes people talk about it in the weirdest possible way. Remember that the last country to come off the gold standard was Switzerland in 1999. And so we've really only had 20 years of having no countries on the gold standard. Additionally, you have this whole period post 2001, post 98, 2001, 2008, where you had a lot more IMF forcing and behavior, let's call it, forcing smaller nations to reserve a particular type of what have you as reserve currency, which really ultimately ended up benefiting the US dollar, the euro, and really almost in some ways away from gold. So you have these really weird dynamics that are happening in the currency market. Again, I'm not an FX trader. Very long answer to your very short question. I don't know. And it's because I think it's a little bit more complex than just the US dollar disappears as a reserve currency. To me, though, the equally as interesting question is, what does the market share of each of these currencies become subsequently? I mean, and what it does for geopolitics is really fascinating, very fascinating, because probably more interesting than the fall of the US currency or whatever it might be is actually the rise of the Chinese renminbi, particularly if it has the potential to have a larger share of overall currency above the euro. Okay. Because for whatever reason, the focus on US dollar is interesting from an FX trader perspective. And that is the right call to be thinking about gold, euro. Okay. But the more interesting geopolitical question, which I try not to get into politics, is what precisely is going to be, if it takes market share over the euro, what happens? I mean, the US, we're in such a great position no matter what comes out of this. We're still sitting with 60%. If we lose down to 50, we're still 50% with everybody else on these much lower shares. Okay, so that's my very sorry. I don't know how to do short answers. Sometimes I've been told. Hopefully you guys didn't get annoyed by that. This is an interesting one. Yes, I love that you brought that up. The rupees will do what the rupees will do. And in a lot of ways, India, so you got to think how amazing it is. And I definitely discuss this from time to time. But again, I'm not an FX trader. This is really the study of currencies because I study liquidity. And I've been really fascinated by liquidity in general for over 2 decades. Okay, since my undergraduate, not even my graduate material. But India, so if for just to get all the other nerds that might be watching me on the same page, or at least to understand what page I'm even interested in, when you look at those reserve currencies, the composition, right? Even though the U.S. biggest market share coming out of World War II, as we also kind of in many ways by virtue of that forced everyone else off the gold standard. Very interesting history of currency there. I'm going to tell it briefly. Hopefully, historians don't get mad. And then you had all these disparate currencies in Europe, and then they basically worked really hard to create the euro, stabilizing it circa the late 90s, early 2000 period, I want to say. I still have, by the way, French francs from my vision, from my study of, like, I just took a trip to Paris, backpacker hostel style. So I still have French francs that that have zero value at this point. So that's that, in my lifetime we switched to the euro, in other words, right? So the euro rising as then the market share, getting its market share of currency, but Singapore as well randomly showing up. I mean, the size of Singapore is so small, and it literally has only been a nation since the late 60s. And then it becomes like a legit currency as a proxy to China. And then China it's not even a floating currency, right? Like, that's how crazy that is. You've got the communist era, no trade internationally. Then you've got the Deng Xiaoping era through the early 80s and 90s. That currency was a big fat nothing as well, okay? Then you've got from 2000 to 2020, that currency goes from nothing, still not floated, to a 3% of global currency, pushing down the Singapore dollar as a percent of total reserve currency. That is the coolest, most intriguing dynamic that you could possibly think about. And why it's happening is also really fascinating. That's the question that you want to really think about. And if you're India, that's actually why you're trying to pump the rupee right now, is because you've got a particular strategy that you're intrigued with as well. Because before China was able to come out of nothing into something on that currency, it was thought that there was only one way to become a reserve currency. And China proved that not to be true. So I won't go too much more in detail because we're already at 37 minutes and I want people to enjoy that and still be intrigued. If you like this, definitely subscribe. I appreciate that. Definitely comment below the types of topics that you're interested in. I would love a follow because I'm just like, literally, I'm so new to social media. I kind of could use a follow on any of these things. And with that, have an awesome weekend, guys. Take care.